Hey there, Rick Bosley here with the Bosley Team Real Estate Solutions. And I'm talking to you if you're thinking about buying in today's market. We've got a lot of buyers we're working with right now. And the number one question we've had for buyers, not only if you're looking for a primary as a first-time home buyer, maybe you're looking to move up or even move down and downsize or invest, the question of contention has been affordability, right? And we know that affordability is impacting everything, especially in the state of Florida, where we're seeing insurance rates are higher than they have been. Interest rates in the past several years are higher than we've been used to and accustomed to. Prices continue to be on the rise. We want to say, how in the world can real estate still be affordable? And we want to look at affordability over the scale. So when we look at that, I want to share a screen with you here. Let's share the screen a little bit of today's interest rates. And this is prevailing market as of the early this week, Monday, March 17th. And the 30-year fixed is 6.8. The 30-year FHA is 6.28. Jumbo loans are 7. And if you do a second home or vacation home, it'll be even higher. And so when we look at these rates, oftentimes many of the lenders that you're working with are able to do some sort of lender credits, or you can do some buy downs or some concessions. So you're probably not going to land at that 6.8. So this is on mortgagenewsdaily.com. It's just a great spot to get the variable. And you can take a look of how does that compare. Now, when we look at that over here, I don't know if you can see this, you can zoom in. When we look at that, it's high compared to what we were used to seeing back in 2021. And that's when things were historically low. But overall, when you look at the 30-year history of mortgages, 6% and 7% is about the industry norm and standard. So when we look at what's impacted the interest rates, think of it like a balance beam, right? And interest rates are impacted by the Federal Reserve. Federal Reserve is impacted by inflation and GDP. So as inflation goes up and people are spending too much money, they have to make things more expensive, like interest rates, to make you stop spending money. And when something like 9/11 happens or COVID happens and spending goes down and we're going into a recession, then they will talk about, well, let's lower interest rates to prevent a deep recession. Now, next week, we're going to be doing an interview, and that'll be the email next week. You can catch it on the YouTube, or if you're in our database, and we'll make sure you get the email again. I'll be talking with someone about what do we see is going to happen, because we're on the verge of another recession here in 2025. And what does that mean, and what could it mean for future interest rates? Now, how does this help you? If you look at Monday's trend, it increased slightly today, and you see that Monday's rate trend, it's minimal. It's right there. And I want to look at this and say, how does that impact you in terms of your payment and your amortization? Now, the average price in Orlando right now, when we look at the median price point, we actually have this market out. This came out of the Orlando market polls today with the median price point of $385. So let's say we're going to go borrow $350 of that, because we have $35,000 down. We put 10% down. We borrow $350. And the down payment we'll do is going to be, let's do 3.5%. Let's do an FHA. So that would say you're going to borrow $337,750 with an interest rate. If we're doing FHA, we said it was 6.3. So watch what happens there for FHA. It changes to about $2,500 a month. Now, if we look at that and we put that against a calculator of what is $2,500 a month when we're going to go borrow $337, well, let's just do that quick math. Divided by 337, and it's 0.70074. And I used to say this is the James Bond theory. So if you've ever been one of my buyers, I might have told you your interest rate all in can be around James Bond. And that's when interest rates were hovering around 5.5%. And that's whatever you're borrowing, double or multiply it by 0.007. And that will give you a pretty good ballpark of what is your total payment: principal, interest, taxes, and insurance. Now, insurance right now, they're not signing it for $1,000 a month. This might be closer to $2,500 a month. So of course, that's going to change, and that's going to impact your payment a little bit. So slightly higher, but it's going to give you a good ballpark. If you're wondering, what is this going to cost me on the monthly impact? You have to account for taxes, insurance, and you want to use that 007 method. So the 007 method, again, however much you're borrowing, if you're right around that 6%, you can say 007 is multiplied by 0.007. If you borrow $400,000, multiplied by 007 is a ballpark of around $2,800 a month. Now, are there other factors that impact that? Of course there are. The age of the house, the insurance, how close it is or not far away it is from the beach or flood zone. Those sort of things will impact it, but it's a pretty good ballpark. Real quick, I want to share with you of how you should look at and calculate taxes as well. When you look at a house for sale and you see taxes, realize that those are taxes not only associated with that house, but also with the person who lives in that house. And depending when they bought it, are they homesteaded? Do they have any portability? Are they military? Are they a widow? Are they blind? Do they have other factors that are lowering these taxes? Or do they rent it out and you have prevailing cost and you're able to carry some of those over? So when you look at taxes, just realize that if you see two houses in the same street, in the same neighborhood, and one has taxes of $4,000 and one has taxes of $1,500, it's not because the house is taxed more. It's because the individual has different tax incentives or brackets or deductions there. So when you look at that, if you are in the home buying search, just realize that taxes will be applicable to you in combination. And depending on the house, depending on the area, depending on the city, depending on the county, you have what's called a millage rate. And the millage rate will be somewhere between 1.2, maybe 1.7% in taxes of the taxable amount of the home. If you buy the house for $400, they might say 85% of that. So that would be about $385, and it's your primary. So you deduct the $50,000 because you're married from homestead, and then you port over from our Save Our Homes Act. You can tell a lot of stuff that impacts the taxes. Don't let that deter you. Call one of us. We will help you understand what would this apply to you. And when in doubt, if you're looking for just general knowledge, use that 007 method. It'll give you a good ballpark. You can also reverse engineer this. If you're renting right now and you're paying $2,500 a month, take that number, divide it by 007. Let's do that here real quick. Let's pull the calculator up, and you can't see it, but I do. So 2,500 divided by 0.007, and it says you can borrow about $357,000, and your monthly payment will be around $2,500. Now, of course, HOAs, taxes, all of that's there. This is general information, but it will help you understand the concept of affordability. We can look at what's happening with recession, what's happening with inflation, and what do we see the interest rates will do coming up for the rest of 2025. If you want to know that, make sure you subscribe to this channel, or make sure you stay on these emails, or make sure you give one of us a call, because we'll be having that conversation next week. Thanks so much for listening. I'm Rick Bosley. If we can ever help you out, give myself or one of our teammates a call, and we'd love to represent you and help you buy or sell a home in today's market. Take care.